In October 2008, Congress approved the Troubled Asset Relief Program, $700 billion to stabilize the U.S. financial system. It was the most controversial vote in a generation. What was not voted on, not debated, and not disclosed for 3 years was this. Simultaneously, the Federal Reserve was conducting emergency lending programs that in total disbursed $16.1 trillion to financial institutions around the world. That number is from the Government Accountability Office's own audit. It was revealed in July 2011. Almost no one reported it.
The $700 billion TARP program required congressional approval. It was debated for weeks. The $16.1 trillion in Federal Reserve lending required no congressional approval. Under Section 13(3) of the Federal Reserve Act, the Fed can lend money to essentially any entity during a financial emergency at its own discretion without prior authorization. This authority was used between 2007 and 2010 on a scale never previously attempted in the history of the United States or any country.
The recipients were not limited to American banks. Morgan Stanley received $107.3 billion. Citigroup received $99.5 billion. Bank of America received $91.4 billion. But Deutsche Bank of Germany received $354 billion. Barclays of the UK received $868 billion. RBS of Scotland received $541 billion. Credit Suisse of Switzerland received $262 billion. The Federal Reserve, funded by American taxpayers' credit, bailed out the banking systems of multiple countries simultaneously.
The interest rates on these loans were near zero, below inflation in real terms, meaning they were effectively gifts. Recipients could take the money invested in treasury bonds at a higher rate and pocket the spread. Goldman Sachs received $814 billion in emergency loans at near zero rates. During the same period, Goldman Sachs paid $16 billion in bonuses. The mechanism for transferring public credit to private profit was direct, legal, and invisible.
Senator Bernie Sanders, who had inserted an audit provision into the Dodd-Frank bill, called the results jaw-dropping. His office published a full breakdown. The Fed's response: all loans were repaid with interest, which was true at the near-zero rates the Fed had set. What didn't get covered, the question of why Deutsche Bank and Barclays received more in U.S. emergency loans than Morgan Stanley and Citigroup combined. That question has never been answered publicly.
The people who took excessive risk and caused the crisis received emergency support at terms no market would have offered. The people who had no connection to that risk, homeowners, depositors, workers, saw unemployment reach 10% and foreclosures hit 3.5 million. The full Federal Reserve audit bill has been introduced in Congress every session since 2009. It has never been brought to a floor vote. The Fed has testified against it every time.
The 2008 bailout is not a case where the system failed. It's a case where the system worked exactly as designed for the people it was designed to protect. That is the documented record. What the record doesn't show is what happens next time. The same institutions, the same exemptions from normal market discipline, the same capacity for a crisis, the same tools available. Subscribe,